Hmm. Hmm.
Good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil trading today a little bit down, but after a significant climb yesterday, as this week seems to be the nerves are back regarding the geopolitical supply risk premium in the Middle East as we see the U.S. Secretary of State for the 12th time, I think, or something like that, coming to the region to try and find some kind of resolution, you would think, or is it just more theater for domestic politics in the last weeks of the election in America? Seems to smell more like that to me than the other. Let's kick off this morning with Malia Bengali, founder of MB Commodity Corner. Malia, where's your assessment in this oil market? Again, it's sort of wandering around with some geopolitical prodding here or there. What's the direction of travel behind the cloud?
Thank you, Sean. I think the main issue for the oil price is demand. As we spoke about before, most of the economists have been expecting a massive rebound in demand from China and the stimulus measures, but we really haven't seen that come through. As you've seen the imports so far of China falling short of expectations, certainly OPEC's expectations. That's why the oil prices remain so depressed, because we've seen the distillate production in terms of distillate demand down, gasoline demand is pretty muted. So there is no recovery, and we know there's a lot out there more looking to come back to the market. So demand is the main issue here, not supply. And yes, there's a bit of geopolitical tensions, but I don't think there's a lot of worries about that, because we saw the oil price actually give back on back of those headlines. So it remains to be seen as to what infrastructure targets they have. But as of right now, they've sort of said they won't attack oil infrastructure. So it remains to be seen, but demand is our key issue for the time being.
Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and a senior fellow at the Global Energy Center at the Atlantic Council. Charles, welcome back. Your thoughts on the direction of travel here? Malia says demand uncertainty. Where is demand? Your thoughts on the outlook for that versus supply as the driver, if you like?
Well, supply is plentiful. There is more oil coming into the market, and there is the United States is producing more oil. Everywhere production is going up. So supply is not the issue. In fact, if anything, there is an oversupply given demand. I agree that China is the problem. And a big issue in China is not just the economy, it's the penetration of electric vehicles. So these last few months, these electric vehicles, car sales in China increased dramatically to almost half of all sales. So, and also the increase in high-speed rail, all of these things are having an impact in the use of oil in China, and that is going down. But there are also others who are warning, like the Bank of America is warning that there could be, with the increase in stimulus in China, there could be an upturn next year. So we need to be careful not to assume that it's all downhill. There could be change, but it's the probability is low, and yet a major bank is telling us be cautious.
Let's welcome Kem Seral, CEO of Cockett Group, to the table for the first time. Kem, thank you so much for joining us. Your thoughts? I mean, we look at we look at the geopolitical risk premium that's sort of floating up and down in the 70s this month of October, the events of October 1st triggering a big soar up to above 80 and then down again. We're wandering a little bit with the uncertainty as what's going to happen next. Everybody's sort of waiting for this shoe to drop. But I wanted to get your thoughts, Kim. Are we seeing this geopolitical risk premium in anywhere else in the market, whether it be in marine fuels, consumption, obviously the Red Sea issue? Are we seeing shipping move, around Africa, and so consequently a bit more stress on that? Your thoughts on where geopolitical risk premium might be showing itself other than on the front month of Brent?
Thank you very much for having us today. As we are specifically marine fuel specialists, we try to understand the impact of such issues to global shipping movements and associated with that to marine fuel demand. Since the start of Israel and Gaza conflict, as you have known, a significant portion of traffic that uses Suez Canal, which is about 20% of global shipping, has moved through Cape. Our assessment is that impact for 20% of shipping is about 40% higher time and days in consumption, which is roughly about between 6 to 8% additional increase to global fuel demand. And unfortunately, the same amount of additional CO2 emissions as the industry is still at the early stages of grappling with decarbonization. The premiums have not been impacted as drastically as initially thought. Similar to crude supply dynamics, marine fuel supply chain sitting across a global landscape, changing demand has impacted a number of buying behaviors moving to east, predominantly in China and in Singapore. However, if the situation, which appears to be persistent at this point of time, we will see the impacted 20% of global traffic will continue to travel through Cape, and the additional excess consumption and CO2 emissions will likely to prevail for the foreseeable future.
Malia, we saw earlier, or late September, early October, the soaring short in the oil market. The financial investors had sort of gone heavily on the short side of the opportunity. I'm wondering, where does that outlook now? Could this geopolitical risk attract financial investors back into the long side of the market? Where do you think the direction of travel is there on the financial investors rather than physical traders?
Well, the financial investors should be looking at macro. And from the macro point of view, if the Fed's going to go on its easing path and cut more interest rates, certainly there's a case to be built to buy commodities. Now, having said that, there's a sort of reason to worry about the fact that the Fed may not cut rates as aggressively as the market expects them to. But then taking a step back, there's some
sorry, you said that's a concern that they won't be more aggressive?
Because the way the bond market have been falling, yields are rallying from 3.5% on the back end to 4.2% right now, because the data
we're seeing bumper employment numbers, and
exactly. So the question
there's a lot of why are you cutting at all would be my question.
Absolutely right. I think they jumped the gun. They got too worried. They cut too soon. The question now is the market still expects them to do another 50 basis point cut. There is a risk they could come out and not cut at all. And if that's the case, we need to think about what that means for asset classes. They're taking a step back from the commodity perspective. Investors are looking to be long pockets of value. There's a lot of value in gold and silver, maybe copper, but not oil. So yes, the financial speculators are looking to be long, but energy is not on their radar right now because they've been burned quite a few times. It's cheap, but it's cheap for a reason. Demand is just not there, right? And there's too much supply around, whereas other parts of the commodity market do see a shortfall in supply. And so they focus on those parts of the market before perhaps looking at oil.
Dr. Charles, where do you think this geopolitical risk is going? You're obviously from Cyprus. In Cyprus, is Cyprus concerned that Israel might attack them next? They're running out of countries to target. Cyprus remaining very quiet about events. Where do you? I mean, it's all right on your doorstep there. Where do you think this is going? Blinken again back in the region? Is this just theater? Your thoughts of where this geopolitical risk and this sort of diplomatic attempts to resolve any of these issues?
Well, Blinken coming to the region is exactly what you said. It's a show. It's driven by American elections. But also intriguing was the leak from the Pentagon of the Israeli plans. It appears that the Americans are trying to slow down Israel from taking drastic action. There would be, I mean, we're getting closer and closer to the time when Israel is expected to retaliate. But it seems to be fizzling out in terms of geopolitical risk. Nobody's expecting anything major to happen. Cyprus is on tenterhooks right now because Al Jazeera had a program where it called Cyprus the backyard of Israel. That Israel is using Cyprus to support its own plans.
And there's clearly reports that the British are using Cyprus to provide air cover in Gaza, to conduct operations in Yemen. I mean, clearly the G7 and its supporting EU countries are not on the sidelines here.
No, definitely not. And the Americans are in at Akrotiri in Cyprus as well. Cyprus is concerned that, was concerned that Hezbollah might do something, but Hezbollah is weakened right now, so there isn't the concern is not there anymore. Cyprus has its own internal problems right now, and it seems that the war in Israel and around it is a bit removed. It's the impact of the war on the region that really matters, on energy flows in the region, on new projects. All of these are suffering as a result of the uncertainty introduced by the war. Even Chevron is delaying the construction of a pipeline to take gas from Israel to Egypt, and that is having a much stronger effect on Egypt than anything else, because Egypt is in serious problems in terms of gas supplies. It needs Israeli gas. Any delays of any projects that bring gas into Egypt are a big issue for the Egyptians.
What about Turkey, Charles? I mean, where are they standing at this? Is there any risk of a greater? I mean, we're talking about the volatility between, Israel to Iran and the obvious proxies associated with Iran around the region, but there's also Turkey and its regional area. We're seeing the Americans heavily finance and arm the variety of Kurdish militias in northern Iraq and northern Syria. Where is Turkey, do you think, in all of this geopolitical chess game in the region?
I think Turkey is saber-rattling rather than actually doing anything significant. I was in Istanbul last week for an Atlantic Council conference, a major conference, and I didn't sense any serious issues to do with Turkey, apart from Erdogan pronouncing whatever he's doing every day, almost every day. Life there seems to be going happily, normally, and the Middle East problems are a bit far removed. So I don't see Turkey taking any action to follow the words of Erdogan when it comes to the region. He will maintain the rhetoric and the pressure on the Israelis and the Americans. And as you know, today he's attending the BRICS meeting in Kazan in Russia, and where Turkey might actually join the BRICS, confusing the issues even further. But I don't see Turkey taking any action other than just keeping up the pressure through words.
I wonder what the acronym would be if Turkey joined, to get that T in there somewhere. It would certainly sound like a Turkish word, maybe. Cem, your thoughts on the geopolitics? I'm not sure if you are Turkish, but your name looks kind of Turkish. But your thoughts on the outlook for the geopolitical risk of the region? Are we still near the beginning of this one-year-old active conflict in the region? Are we near the end? Your thoughts 2 weeks from an American election?
I think it's a pretty critical stage that we are in, as you mentioned. And U.S. elections play a significant role in global politics, and the remaining 2 weeks is pretty critical. I'm based in Dubai now, and as you know, we are looking about 1/3 of global oil traffic going through Strait of Hormuz, and any disruption to, or even the perception of disruption to oil supply will have a significant impact on oil markets. In addition to oil, just Qatar in the region has the 20% market share in global LNG market. So any disruption into this traffic is far exceeds the impact of disruption of Iranian exports. We agree that there's an excess capacity in OPEC Plus to be able to assess and assist and increase in by increasing capacity to bridge gap. However, majority of the OPEC Plus supply also comes out of the Middle East. So if there is any significant escalation that may impact traffic out of this region, it will have global consequences. I guess from a political standpoint, it's not in political landscape's interest to see higher oil prices close to an election cycle. But on the other hand, there are so many different angles and perspectives that may very different roles in how next 2 weeks may play out. From our perspective, we are mostly interested in trying to understand how the dynamic may impact short term, and until market rebalances and consumes and digests the news, how the markets can find a way to rebalance itself through increased supply.
Maliha, we had overnight the report by IMF upgrading growth forecast for 2024 in the United States, a fairly significant in terms of relative above 2 point something percent, and then China was downgraded a little bit. Your thoughts on those and what they tell us about the outlook for demand from an oil point of view? I thought that the U.S. numbers look quite strong. China are more or less in alignment, down a little bit. But your thoughts on that IMF report and what it tells us about where we go with demand here?
That's a good question. I think a lot remains to be seen as to who takes the White House and if it's a Republican sweep or not, because we're keeping a very close eye on some of the fiscal measures and spending plans. It all depends as to how the government is going to promote consumption and of the economy. The U.S. market has held up, you're absolutely right. But as we said before, it's a two-tier economy. We've seen manufacturing softness and services being held quite strong. So the question really is, can we see manufacturing bottom? And I'm not sure we have indications of that. So the demand numbers look a bit aggressive. But like I said, we could see Trump take the White House and come up with some really aggressive measures, which could actually boost that. So we're taking on a step-by-step basis and the case to be made. But then we also have to take a look at inflation. Because if we talk about massive spending, the bond market's already crying right now. And if you see inflation tick back higher, that sort of leaves the Fed on the back foot. And that can again curtail some of that demand growth. So it's really quite a dynamic process and not that easily cut as that. But for sure, US is holding up a lot better than China right now in some of the measures. So those reports numbers make sense, but we're not that aggressive on those demand numbers just yet.
What about the point Charles made? Don't underestimate China's commitment to stimulus. We've seen it sort of kick off in the last few weeks. It's sort of had a big sort of shot out at the first kind of go and then petered a little bit. Your thoughts on where China might go, its commitment to stimulus, its commitment to drive greater economic activity and energy demand?
There's no doubt China wants to find some sort of a floor for the markets, but their entire policy is not like it was 10 years ago. The market expects them to come out with some bazooka stimulus. So for them doing 3 or 4 trillion to support equity markets is not the same thing as them actually stimulating growth in the economy. They want to boost domestic consumption. I think that's the biggest thing that we've gotten all wrong for the last 2 years. China's not going to do what they did back in 2008 or 10. At least we don't think so. So the question is, yes, they're trying to support some pockets of value, but for them to come back and have a massive surge. And also take a look at the Chinese debt to GDP. What they did before, they need to do 5 times or maybe 10 or 15 trillion to even make the same impact. So China has to do a lot more, but their currency is in decline. So they really are quite sort of strapped as to what they can do. So yes, this is supportive, but is this an outright go and buy China? We don't think so, right? The markets were very short. They rallied aggressively. They've given half of that back because the market is in sort of wait or see mode. But I think if you listen to Xi Jinping very closely, he's not talking about the same things as the market expects from the last decade. And I think we need to focus exactly which parts of the market he's actually supporting as opposed to the blanket sort of buy everything China.
Yeah, the Chinese consumer does not like to spend money. I think that's the bottom line. It's going to take a big incentive to them open their wallets. Their nature is much more conservative. They don't have the social nets that you might find in Western Europe. Let's go to the survey question and see where the view in the room is on this outlook for geopolitical risk. Do you believe the one-year-old active conflict in the Middle East is closer to the beginning, closer to ending, halfway approximately, or geez, I have no idea? Which is it, in your opinion? We've seen, obviously, the situation in Ukraine now into a third year, the no end in sight. Closer to the beginning, closer to the ending. It looks like this Israeli government is another 2 years in power. They've got a lot on their agenda. So where do you think this is? Halfway approx. Let's see where the view in the room is. Charles, all things Europe. I mean, we are 2 weeks away from a US election. It doesn't seem to me that the energy markets, at least, or perhaps any financial markets, are too concerned at the moment about whoever wins. Europe should be really concerned who wins this election, no?
Europe is preoccupied with its own problems at the moment. Not only Ukraine is probably going in the wrong direction at the moment, needing more support which Europe cannot provide. But Germany's problems are still continuing. This year, 2024, German economic growth is going to be barely positive. And it doesn't seem to be recovering. There is a downgrade of Germany by financial institutions. The industrial recovery is not coming. And on top of that, we have France in a mess at the moment. Barnier is trying to recover the economy, but it's not going to be easy. And even the glimmer of hope in the UK with a new government, with a majority coming into play, it doesn't seem to be working very well. There is a huge £40 billion deficit in their budget they're trying to plug. And they are doing crazy things at the moment. There is a concern that the measures they may take may actually have the opposite effect on economic growth than we
Taking heating subsidies away from old people seems like a terrible place to start.
Yes, and attacking pensions and all sorts of things that one would not expect. So
there's no leadership in Europe, basically. Germany are distracted.
And increasing problems, and it's inward looking at the moment. And in Brussels, the European Commission is in the middle of this change that is going to happen. The hearings for the new commissioners are still to come early next month. And while all of these things are happening, Europe is not giving a lead. The Brussels is not giving a lead either. So all in all, Europe is inward looking. Trying to lick its wounds and find a way forward. Having said that, the forecast for next year's economic growth is better. So this year, economic growth in Europe is expected to be about 1.2%, even though in Germany it's going to be 0.1%. But next year, that 1.2% has been increased to 1.8%. So there is some glimmer of hope coming out of Europe into next year, irrespective of the US elections.
Cem, I wanted to get your thoughts on decarbonization. Of course, we've been in a very conflicted period. We went from like energy transition obsession to energy security obsession, which is now kind of derailing commitments to decarbonization. Shipping, of course, one of the big leaders or one of the big consumers. We had IMO 2020, a whole set of new regulations for shipping to meet by 2030 and beyond. Your thoughts on the decarbonization journey in the shipping space? Is it happening? What's the outlook there?
Clearly, there's more awareness and more activity towards decarbonization across shipping and subsequent marine fuel industries. But if you look at the data, unfortunately, it shows us the ambition set versus the reality seems to be quite different from one another. Right now, there's about 61,000 ships in global merchant fleet. And out of those, we have less than 1,500 ships with a capacity to use alternative fuel, which will be direct impact and positive impact to decarbonization. That's about 2.4% of the global fleet, which is admittedly pretty small. Another component is to look at the order book, which is ships to be coming online in the next few years, and that number is about 5,200 ships. The positive news is that in our order book, we are looking at about half of the fleet is with a form of alternative fuel capable ships. But even if you combine both of them, we are looking at no less than 5% of the global fleet with a capacity to use a form of alternative fuel over the next few years. The other component is obviously not just ship financing, but as well as capacity to build new ships, which is directly linked to shipyard capacity. And what we see that it is shipyard capacity is pretty high in terms of utilization. It means that there are significant bottlenecks in terms of being able to put a new and alternative fuel capable ships into water before the end of the decade. We have a number of new regulations that either has come into play or about to start, such as EU ETS, which is a trade of carbon emissions for use in conventional fuel with the matching EU allowances. 2025 onwards, we have Fuel EU Maritime joining in the mix, where it's mandating a small percentage of consumption to be a non-conventional fuel sources, as well as we are seeing.
So it's certainly like a ship moving through the ocean. It's slow moving. Malia, I wanted to get you wrap up the last commentary here on supply, because unlike you guys, I'm a little bit more focused on supply concerns than demand, because I think demand is pretty predictable. We're kind of in October and early November. We kind of see where demand is at. But I think the fracture is on supply. What's OPEC Plus going to do? It's going to raise supply in 5 weeks' time. Is Iran sanctions going to come back and shut into close to 2 million barrels a day there from the Trump administration? So from a point of view of supply, I wanted to get your views. Where do you think OPEC Plus are going when they look at the sort of the tea leaves of all of this? They've got a big decision to make.
You're absolutely right? As of right now, they promoted that they're going to be bringing back production by the December this year. The question really is if prices are probably staying close to 70, 75, that's debatable, right? Once again, going to the White House, if you get Trump in power, we know he's been a bit more hard on Iran. That could take a lot more barrels out of the market. So there's so many moving parts right now, but it is even if you take 3 million barrels worth of Iran out for whatever reason, we still have 6 million barrels worth of OPEC supply there. So we need to understand the context as to the only reason why the oil price has held up so well has been because Saudi Arabia and OPEC has been pulling back production. So when a market is dictated by supply being pulled back, it's not very positive. It'll only rally sustainably if demand starts picking up. But you are right. At some point, Saudi Arabia has waited for 2 years now, hoping the price would be at 90 before they need to release this. They didn't expect this because we know their assumptions from last year have been too aggressive on oil, and they've gone the China demand story completely wrong. So the question really is, will they do what they should have done 2 years ago? Flood the market, get rid of all the high-cost producers, and then sort of, take their control, or wait another few months? That remains to be seen. It's a very political decision, and it's very hard for us to talk about that. We know what they should do, but obviously what they do will be a very different game altogether.
Charles, last word to you on that. What do you think the outlook is for OPEC Plus? They made these announcements earlier this year, very granular details on increases due in October 1st. They postponed for 2 months. Where do they go here, do you think?
I think they might increase production. I mean, OPEC Plus, including Saudi Arabia, went out of their way to say that they don't have any specific target for oil prices. To me, that implies that they are going to increase production. Pressure on OPEC Plus to increase production is increasing. They will increase production. I don't know by how much. And they are aware that it will have an impact on oil prices, but they seem to be less concerned about that right now. The cohesion of the group matters more, and if pressure within the group is to increase production after holding it for so long, I think they probably will go ahead.
Well, we're going to have to wrap it up there. The outlook for OPEC Plus to proceed with increases from December 1st. It does look increasingly difficult that it's not something they can back away from now, and maybe it solves a few problems and sobers everybody up. Here on the outlook for the active conflict in the Middle East, closer to the beginning gets a bit more attention, and here alongside halfway approximately. So clearly not near the end is what we're getting from this message. And we'll put that question out on social media and see where we can get a feel for a wider audience. Thank you so much. As always, great to have the insights from Maliha Bengali. Of course, great to see you and to welcome Cem Saral, and to thank Dr. Charles Elinas. As always, great to have your insights. Have a great day, everybody, and catch up with you all soon again. Thank you.
Thank you, Sean.
Thank you.